Hello, good morning everyone. Welcome to ECONOVID 2020 research paper presentation organized by CASPR. We have with us our presenters Deepthi, Sara, Anil from IIT Kanpur, and our panel members include Ms. Ankita Garg. Presenter, please start with the topic now.
All right. Good morning. The topic that I'll be presenting is called Health Insurance Coverage During Epidemics in India, a preliminary analysis of COVID-19. So whenever there is an epidemic outbreak, the influences of impacts can be direct and indirect. So direct impacts would cover health sector and indirect would obviously lend its influence to the business economy. So we see insurance sectors all over the world stepping in to cover losses in life and business. And in 2002 and in 2011, we find precedents set by SARS and MERS showing an upward trend in demand for health and life insurance policies. But there's also a danger involved. That is, the tendency of saving policies have shown a potential to remain weak. And there can be a drastic cut in the revenue into
Your
channels.
voice is not clear.
Am I audible right now?
It is fine. It is better than before.
Oh, I'm sorry. I didn't realize.
Yeah.
Do I have to start?
Yes, you can continue.
Okay. Yeah. So there has been a drastic there can be a drastic reduce in the revenue channels of the insurance firms, as well as a situation where the policies cannot be renewed because the individuals, they could prefer to keep the money within themselves. I mean, they would not prefer to give away the liquidity or the disposable income that they have. And the impact of health insurance can be a function of different factors like the infection rate, the rate of transmission, the mortality rate, and whether the insurance policies are covered by the government or whether the private sector has a role to play, or whether the level of coverage extends to all the stages of progression of the disease, like from when it's diagnosed to when the individual has to be hospitalized to when they are discharged and then medical facilities or post-hospitalization expenses are provided. So all these matters play an important role. So with COVID-19 outbreak, the demand for critical illness insurance has increased so far as indemnity covers, which is a good thing. Because in India, the penetration of non-life insurance is very superficial. It's only 0.90%. That is the premiums as a percentage of GDP. It's very less. So COVID-19 has in fact provided a boost to the insurance, the private insurance sector, we can say, because there is a niche market that is being created in the case of fixed benefit covers, where you offer a lump sum for the COVID treatment ranging from 21,000 to 2 lakhs, and you can use that. So what my paper is trying to do is, it tries to understand whether the importance that has to be given to the commercial health insurance involving an epidemiological system by integrating an SIR model along with an actuarial framework. So the literature review is basically Pereira in 2018, Lefebvre in 2017 put forward a model by which they were the first ones to integrate an epidemiological and actuarial model together. They said that integrating you can provide an optimal premium by which coverage can be provided to the insurance buyers, as well as at a level where the insurance companies can maintain their profit levels. The net benefit reserve could be kept positive. And Dreyer, in 2007, before that, he came to a staff classification. He said that the severity of an epidemic outbreak can be determined according to the burden it faces on the insurance company. So he said that the epidemic can be classified severe if the insurance burden is severe on the insurance company. And after the COVID outbreak, obviously there has been an influx of literature on the field. So it's basically projections have been done on the estimated rates by CDDEC, ICMR, and John Hopkins. So they have come up with different projections of the amount of rates that we can expect. So in August, according to John Hopkins' projection, we have gotten an estimate of 1 to 2.5 crores, which is worrisome. So my research is novel to this by trying to apply an integrated epidemiological and actuarial model to the novel case of coronavirus. And I'm trying to establish on relevance of commercial health insurers in the context of the COVID-19 outbreak. Now, the data source, I've taken it from the Ministry of Family Health and Welfare and COVIDindia.org, and the study has been done for a period of 5 years from January to May. And the actual data has been taken from insurance companies and IRDAI annual reports. Now, the methodology is basically a simple SIR model, so dividing the entire population into 3 compartments: susceptible population, infected, and removed, and trying to ascertain the rate of transition from one compartment to another. So the rate of change can be analyzed as a dynamic systems model because the compartments are changing when itself. So the rate of change can be respective derivatives. So the rate of change is proportional, like the people in the susceptible compartment is proportional to the people who are infected, because the contact can be established and they can move out of the susceptible compartment. And the rate of contact establishment is known as beta. In layman's terms, we denote beta as the transmission rate. And here we have seen the 3 respective derivatives for this model. So my basic model is the basic SIR model.
Still unclear.
Oh my. Is this better, ma'am?
Yeah.
Okay, please do tell me, ma'am, when it's
you can start.
going off.
Yeah.
So since my model is just looking into augmenting the insurance findings, I'm going with a basic SIR model. So the assumptions are pretty basic. If the total population remains constant, an average susceptible makes an average number of beta contacts just adequate enough to transmit the disease. And then alpha is the removal rate from a particular infected compartment. And the ratio between beta and alpha is known as the reproduction rate, which we are well aware of. Now, developing the insurance counterpart. So these 2 compartments that we saw, the susceptible and the infected compartment. Now, these 2 are respective markets for the insurance company. So the susceptible compartment basically provides the premium. So when they avail a policy, they're paying a premium to the insurance firm, and they are the revenue generators for the insurance company, while the infected people, as a person is transiting into an infected category, then they will be recipients of the benefit claim that the insurance company will have to pay for the coverage that they availed. So they will be the liability side of the insurance company. So from here, we can understand the insurance liability side and calculate it as the total discounted value of the 3-year annuity of payment benefit, and this is given by this formula. And the revenue side can be calculated by this formula, which takes into account the amount of susceptible population, because they will be the ones who will be paying the premium. And here we have the infected population, because they will be the one who will be receiving the benefit claims. And the level premium can be taken as a ratio of these 2. But here, another alternative that needs to be looked at is taking this model into consideration using only the infected instead of the susceptible, because the susceptible population, the figures are very difficult to get. The infected population figures is available on a public domain, so we can recalculate 4 and 5 as 7 and 8, and then take a ratio to attain the level premium. Now, in order to look at the profitability of an insurance company, we're looking at the PT value, that is the accumulated value of premiums, and DT value, that is the accumulated value of benefits, and take a difference, that is the accumulated benefit reserve at time T. The difference should tell us whether the company is trying to maintain its hold, whether it is sinking or they need help at the moment. So our goal here is to keep this derivative maximum or positive. That would be the goal. Now, the data analysis proceeds with a depiction of the current trends. We can see the accumulating infected going up, the recovered people also assuredly going up, and we have fitted the infected category into a nonlinear exponential function in order to give us the basis for prediction. So also, in order to provide a more realistic measure of infection, non-pharmaceutical intervention parameter a row has been introduced. So basically, it's a social distancing parameter, and row lies between 0 and 1, 0 when there is no contact between two individuals, and 1 for when things continue as they are right now. So one thing to be noticed is right now, since we have a projection based on the numbers, social distancing factor is actually embedded in the model because we have 4 phases of lockdown, so it's actually embedded. So when I say CA is equal to rho is equal to 0.9 and rho is equal to 0.4, I mean almost in the first instance 10% of less contact than what we have right now, and the second instance 60% of less contact than what we have right now. It's not an absolute measure, it's a relative measure. So when I did the first prediction until the data using April, the predictions that I got were actually phenomenal. For June, I got 13 lakh until it can go to 85 lakh. It was actually exponential. But taking the data with respect to May end, until May end, I'm getting 2,81,000 during the first week of June, which is very close because we've gone over the 2 lakh figure by now, and all the way up to 1.31 crores in August, which is similar to the John Hopkins study. And we can see a difference of almost 7 lakhs if we can increase the, if we can decrease the contact by at least 10% over here. So that is the study used. And the reproduction rate also shows a declining trend. When I used the data until April end, the reproduction rate that I got was 1.69. So coming to May 15, the rate that I got was 1.44, and coming to the end of May, it was 1.21. So that is a declining trend in the number, the risk of infection. And just out of curiosity, I also did a herd immunity test. So it says that according to this model, herd immunity can be achieved at 17.35. That is, if 238 million population of India are infected with the disease, probably maybe we can achieve herd immunity. And there has been an instance of Princeton scholars saying that because of the economic backdrop, herd immunity might be the only way in which we can move forward also. So now trying to establish a linkage to why we need a commercial housing. So we know that 1.28% of GDP is only invested in public expenditure, and according to the Global Burden of Disease study, the healthcare access and quality index ranks us at 145 out of 195 countries. And the National Health Profile gives us the following statistics. For every 1,000 population, we have half a bed, and we have like 7 lakh beds in government hospitals, which converts to 57 ICU beds and 26 beds in ventilators. So as per the estimates that we got from the SIR model in this study, the 7 lakh figure in the most optimistic trend would figure somewhere in July, and it can figure in June as well. So we can see that there is a gross inadequacy of the public provision of beds or public infrastructure of health that is being shown. And there is also a disparity among states. So 12 states account for 70% of the population of India. And in most of these states, the bed average is less than the national count. So in Bihar, for example, there's only 0.1 bed per 1,000 population. The disparities among states is huge, and the present mortality rate would figure from 3 to 5%. So nearly 105,000 patients would need an ICU. So there's a lot of inadequacy that is being projected from our current public health system. So, and there's also a trend among people who live in Tier 1 cities and metro cities. They have a distrust towards government hospitals. So they prefer to spend out of their pockets. In fact, 67.78% of our population have out-of-pocket expenses. That is a huge amount. So that means either the public hospitals, which give more and more diseases are coming out of the coverage of our public hospitals, or people are tending to move towards private hospitals for their health concerns. So here we have a playing field for private hospitals. Now there's a danger of the public not approaching a hospital fearing the cost. For example, for COVID treatments in government hospitals, it takes, the estimated cost would be 25,000. In a super specialty hospital with the minimum, with their average COVID treatment for 15 days with ICU coverage, it can go up to almost 7.5 lakhs. So the government has capped the test rates and the insurance rates, but the healthcare rates have not been capped. So you may ask, 80 Ayushman Bharat insurance schemes are being provided. Yes, they are being provided to more than 54 beneficiaries, and as of April 4th, the treatment for all COVID cases are being provided under, can also be availed under Ayushman Bharat insurance. But there was a study in 2020, in the first January, February by Chaudhary and Datta. They said that the correlation between per capita income of states and empanelment of private hospitals under insurance, public insurance policies are in fact high. That means low-income states are not going for any policy that is offered, insurance policy that is offered by the state, because their business models are not really compatible with the capping of treatments that these insurance policies go. So there's a question of profitability. So there's a huge reluctance of these of these private hospitals joining the insurance, the government supplied insurance policy. So when we come to the standalone private insurance companies, we see a 27% growth on year over year. That is, from last year, we see a 27% growth in their business. And on April 1st, IRDA issued clearance to 29 general and standalone health insurance companies to market low-cost products called Arogya Sanjeevani. So basically, it is a one-year term policy that offers a coverage of 1 or 5 lakhs, just two options, with premiums ranging from 1,000 to 7,000 for COVID-related expenses. Now, other than that, all health insurance products that have hospitalization coverage will also have coverage for COVID-related cases. So what I'm going to do here is comparison has been made regarding the provisions and benefits under the Arogya Sanjeevani product and the insurance product of 5 lakh coverage for 7 standalone health insurance and 3 private general insurance. So the yellow highlighted ones in this slide and the next slide show the standalone health insurers. So what we can see is, and the bracket is the premium. So I've calculated the premium by taking an average of first, second, and third tier cities for a male in age category of 40 to 60. That's what I've done. And see, the hospitalization treatment, the hospitalization coverage is provided in all these 11 policies that have been mandated by now, so it's covered. And a pre-hospitalization in terms of pre-diagnosis or going pre-hand to a certain year disease. That has been done for 30 days in Arogya Sanjeevani, and it varies from 60 to 30 in most of these cases. And post-hospitalization, after your discharge, the follow-up varies from 60 in Arogya Sanjeevani to or even 180 in some of the other policies. You can see it as 90 the Dutch and Tata specific products. Now, the domiciliary hospitalization, which is required for patients when beds might not be available in the hospital, or when they're not in a position to travel to a particular hospital that is under their network, that has not been provided in Arogya Sanjeevani, but it has been provided in some of the other standalone insurance providers as well as other general insurance. Medical practitioner fees have been provided in all the 11 products, as well as ambulance has been provided in all the 11 products. So the coverage for ambulance is basically 2,000 rupees per day of the, or 5% of the sum insured. That is mostly, majority. And the daycare has been covered for most of the 11 products. And ICU has been covered for 11 products, with exception of Cigna TKK. And cumulative bonus, that means if they have a claim-free year at the present, how much of their sum insured can they receive as bonus in the next year? So in Arogya Sanjeevani, I've taken Arogya Sanjeevani as some product. I've just taken the benefit and the provisions provides, the premiums can vary according to the company that is offering it. So I've just given a rough estimate of 5 to 7. So that can vary. That is the only variation in ROD continuing policy. So for ROD continuing, it's 5% and up to 10%, and it can also go up to 100% of the sum insured for most of the other standalone as well as the general insurance companies. One thing that we should notice is because it's a 5 lakh coverage, critical illness is not provided because that would have to be taken as an add-on. Here, HDFC provides critical illness at a very low cost. So does Cigna TKK. And Birla, the critical illness for 16 diseases has been. Hello?
Yeah, Deepthi, sorry for the interruption, but we are running out of time and we need the panel to put up the questions as well. Can you conclude within 2 minutes?
Yes, just 3 minutes.
Okay.
Just 3 minutes. Yeah. So, Birla has taken a critical illness coverage for 16 diseases in fact. Now, in order to assess the profitability of where the insurance company stands, a certain simplicity of the analysis has been maintained by the following assumptions. So I'm just looking at where the profitability in terms of premium payments, benefit claims, and benefit reserve stands in terms of the 7 standalone health insurance and the 3 companies. So ROD continuing products are excluded from this particular analysis as they are marketed by different companies with different premiums, although their provisions are the same. So the scope of the intended elementary analysis would widen drastically. And then it is also assumed that the entire population takes a single health insurance product. And the third would be total number of products marketed would be equal to total population size. So that is just for the second part of the analysis. And then the premium payments is yearly, which may be a limitation because right now premium payments are also being allowed in installments. And then claims are carried out for the entire sum. So based on this model, what we see is all these 10 companies, we see the blue line indicating the premium collected. So it is on an upward trajectory. The orange line, that is the benefit claim, is also on an upward trajectory. But at the moment, the gray line, which is an indicator of the net benefit reserve, is also positive. So on all 11 companies, that is being shown as positive with varying amounts. So that shows that the number of susceptible population is still quite large. Therefore, obviously, we're taking a hypothetical situation, but the premium payment is in fact considerably high compared to the benefits claimed, because most of the population is still dependent on the government to cover their medical expenses. And there exists a substantial amount of reserve with insurance companies as the infection rate is still climbing. Therefore, the private insurers are right now largely unaffected by COVID-19. There's a demand for health insurance products up to 40% more than what it used to be last year at the same time. It's because procrastination has been driven out and urgency has settled in. The renewals have increased. What they used to do before was once you take a policy and there has been no claim for a year, you would just let that be. But right now people are renewing their policies. Now conclusion and the way forward would be, basically the project conclusion would be over here. The way forward for insurance and health insurance as a whole, some things that have caught my attention would be the tax incentive that was offered before, this tax exemption that was offered before has been, it's sustainable right now according to the optimal tax regime. So the deductions, if you offer deductions and exemptions, then you cannot offer lower tax bracket. So in case of the amount of disposable income in your hand, it's definitely a questionable statement. Then you have agent network stoppage, especially in countries like India and China, where you depended on door-to-door sales of insurance policies. That has been drastically cut off because of the social distancing measures. So we need to go forward with digitization, definitely, but it also depends on whether how the buyers or the customers want to be informed of their policies that they're taking. Do they want to be informed of it by personal contact? Do they want to build that trust equation? So that also matters. Then clarity on rules for insurance IPOs. This might not be a short-term measure, but over the long term, like the life insurance policies are given ahead at IPOs, maybe health insurance policies can also resort to this, can be allowed to resort to this in the future. they're more lucrative for foreign investment once it picks up. The digitization, the extent of digitization that has happened in the last 3 months offers huge scope for cyber insurance. So that is a huge level field that has opened up right now. And the differentiation, like New India Insurance Scheme, the farmers package, United India Workmen Medicare policy. So right now we can focus on packages catering to just pandemics, just epidemics, just outbreaks, or healthcare workers, essential workers. There's a lot of differentiation which we can apply. Then importance of reinsurance companies will emerge once the private sector is fully immersed into providing treatment, because then the importance of these will be highlighted. Right now there's just two, but if they're fully immersed in the business, surely this side will also come forward. Then co-payment clauses can be waived under certain circumstances. The co-payment clauses that can be found in ROG Sanjeevani and a lot of other insurance policies can be waived because it leads to a lack of disposable income in hand, so it can be waived. And then term and guarantee products will gain more market. People are looking for assured coverage based on the premiums that they pay. So these are some ways forward for the insurance sector, both life and health post-COVID. So thank you.
Ma'am, questions or inputs from your side?
Yeah, Deepthi, there are 1 or 2 questions from my side. Very nice presentation. That you told about that there is an assumption of single health insurance product. So I wanted to know if this assumption is not there, what would be the effect on your model? And secondly, I wanted to discuss about your prediction of 13,55,000 figure you gave and 85 lakh figure you gave for April. So, I wanted a clarity on that.
Okay. So, ma'am, the projection until April, when we look at the reproduction rate, it was actually 1.69 at that point of time. So in April 1st week, in fact, the reproduction rate was 1.89 according to news estimates we see and ICMR estimates. So obviously, when you have prediction forecasting models at that point of time with such a high reproduction rate involved in question, the figures will obviously inflate because of that. And right now we have come to, based on current estimates, we have come to a point where the reproduction rate can be adjusted at 1.21, which is a very drastic reduction. So because of that, definitely the forecast and the prediction has lowered, I feel. And ma'am, the second part of your question, if we take away the assumption of single health insurance, I feel, ma'am, then we'll have to look at segmented markets. So segmented markets may obviously a figure of competition comes in. So here we are assuming a monopoly. So we'll have an altogether different model.
Okay, thanks. Thank you.
It would be an oligopolic model. Yes, ma'am.
Okay, so I would like to thank our researcher for her substantial contribution and our panel member for her valuable inputs. Thank you for being a part of ECONOVID 2020.
Thank you so much. Thank you.